Let's get into how you potentially play this in the ETF market. And Scott Helfstein from Global X ETFs joins me. Scott, a lot of focus has been on AI, and we saw that with Oracle overnight, but now it's really getting back to this defense play as well. What's the best way to defend your portfolio, your assets against this uncertainty?
Well, we've seen tremendous interest so far this year in a fund we call Defense Technology. It's done quite well. A matter of fact, if we look across U.S. and global equities, one of the defining characteristics of funds and investments that have done well so far is that they are inherently low volatility. And interestingly enough, while geopolitical turmoil creates volatility, traditionally defense companies are fairly low beta assets relative to the broader market because they have long tails of cash flow and they tend to have long-term contracts. So we continue to think defense technology, whether you look at obviously the news with what's going on with Israel and Iran, but more broadly, you look at the continued tension between the US and China over Taiwan, and the US likely to try and push through the next, or the first ever, I should say, $1 trillion defense spend bill, at the same time that Europe, the NATO allies, increasingly concerned that they might have to face Russia on their own, are talking about increasing their defense spend from their required 2% of GDP up to 3%. So in aggregate, you're talking about hundreds of billions of dollars. And you're also facing an environment where the traditional defense platforms aren't necessarily quite as valuable as they used to be, because as we've seen in Ukraine, you can use a $20,000 drone to take out a $20 million warplane. And so the nature, not just the pure defense, not just the pure spend aspect, but the nature of how countries are spending on defense, smarter, faster, smaller platforms that are putting automation first, that are backed by data and intelligence in integrated systems, that's an important part of the future.
Yeah, and it sort of puts paid as well to my earlier question to Mark Todd, and I have a feeling you might have a different answer, Scott, and you are based in the US. Amidst this uncertainty, do we then return to the safety of US Treasuries, US assets, i.e. is US exceptionalism not over, as many people have been saying?
So I do think that the international trade we're seeing is in some ways more tactical. What we can point to is that there have been strong flows from abroad into U.S. international markets for a long time. And really what that boiled down to was, out of Asia, people that wanted to sell into the U.S. consumer market, particularly China, and out of the Middle East, energy resources that were going into the U.S. market typically stayed there, because people said we might as well leave these dollar-denominated assets and invest in U.S. tech and U.S. growth. And so as a byproduct, I would argue we've wound up with this fairly large U.S. overweight, whether you look at metrics like market cap to GDP, market cap to revenue. The United States sells largely at a premium. So I don't think what we're seeing is necessarily a vote against the U.S., or what we're going to find out is it shouldn't be. But what we are seeing is international flows that I think are more about trying to equal weight the rest of world relative to U.S. and the volatility that the earlier guest, was talking about, because we're probably going to continue to create some waves around trade. There's obviously no shortage of geopolitical tension, but I don't think people should run away from this notion of U.S. exceptionalism, because what makes the U.S. great, it's two factors: it's innovation and it's a strong consumer. And those two things are true irrespective of who's sitting at 1600 Pennsylvania Avenue. And the U.S. economy, the dynamicism of it is so much bigger than any one particular individual, any one particular party, or any one particular administration.
All right, Scott, moving away from this breaking news and, of course, the thematic into defense stocks, defense ETFs, where is the other big play at the moment? I mentioned Oracle hitting a record high overnight, really fueling optimism here about AI.
So We do. Obviously, low beta has worked. Things like defense technology, cybersecurity. We do think that those remain really salient going into the second half of the year. But we also encourage people to think about where they can get growth at a reasonable value. And I think we don't talk about this enough. There is a transition that has gone on where we think about growth investing as you get high top line, high sales growth, but you pay for it in low profit margins or low profitability versus value companies where you get very little sales growth, but you have pretty reliable margins. Well, for really the first time in history, you can buy growth that is profitable, and a matter of fact, growth that is more profitable than value. And so we think investors should continue to focus on innovation. A couple areas that we like, for example, artificial intelligence. I would argue people have not missed it. It is bigger than one or two companies. We think about it, it's a basket of about 80, but it's 80 companies that have superior revenue growth forecasts and superior profit margin forecasts than the S&P, but it sells at the same multiple. So if we want to go to the concept of growth at a reasonable price, or where has the sell-off over the last few months left opportunity on the table, it is in an area like AI. Another one is digital infrastructure and data centers, which are obviously powering a lot of this innovation. And I also think investors should continue to pay attention to robotics, which is the physical automation, versus AI, which is the cognitive. And those two things are going to continue to come together. So don't count out the US as a lead innovator, but obviously China is a big investor in robotics and in AI. And this is just the global trend. It's towards innovation and greater efficiency through the economy.